Earnings week is here and it's big. And the big question remains, do you buy before, after, or not at all? Are Palantir, Amazon, and AMD smart moves, or could they end up being costly mistakes based on where they're selling today? Let's break it all down so you can decide. Stock number one, AMD, Advanced Micro Devices. Guys, this company is actually down a lot from its all-time high. Look at this. Just March of last year, it was at $227 per share. It is now at $112. That's a fall of over 50%. Actually, the low was last week at $112. It's currently at $116. Now, this is a company that makes phenomenal chips, absolutely incredible chips, $190 billion market cap. And here's what I love even more. This is their enterprise value of around $200 billion. So they only have $10 billion essentially of net debt. And that's pretty awesome considering their free cash flow. But interesting thing enough about their free cash flow, their 5-year average was $2 billion. 1 year is 1.56. So is this a downward trend? This is not like NVIDIA. You look at NVIDIA and this is where their free cash flow is going. And it doesn't seem like it's going to stop. But AMD is used to this. AMD has been the company that, in the last 10 or 12 years, it was selling for around $1.50 or $2 per share. They've always made great chips, and they've always been kind of second behind somebody else. But they have great things going for them, like I said, 48% gross margin and probably getting better. This profit margin is actually a little bit lower than I expect. It's showing a 5-year average of 10%, and last year at 7.5%. But my biggest concern, 1-year PE, 105, 1-year price to free cash flow, 122. That's a little concerning. For a $200 billion company, how do you generate outsized returns when you're already selling at 100 times earnings and free cash flow? That's tricky. So let's go look at the 8 pillars and see what that's telling us here. All right, we've got 4 X's and 4 checks. The great checks are revenue's up, net income's up, free cash flow's up. And the great thing is free cash flow and net income are up by the same amount. What I don't like is they're only up about that 9%. 9.5% based on the revenue here. Low debt, like we talked about, which is great. But look at this, guys. Shares outstanding. This is my big red flag. Let's see if I can draw a flag here that's red. Red flag here. 35% more shares outstanding. That means if they had 100 shares outstanding 5 years ago, they now have 135. That makes you, if you've owned the stock for 5 years, you've been diluted. This is a silent killer in investing. Now, it can end up being fine. AMD could turn things around, not issue more shares, but I actually don't blame them for issuing shares. Guys, they're sitting there saying, hey, if people are going to pay us 100 times earnings and 100 times free cash flow, let's just give them shares. It's better than taking on debt. That's kind of a good indication that the stock is overpriced from management's perspective, okay? Now, they had a great and transformative 2024, riding high on record growth and technological breakthroughs, but it hasn't been without its hurdles. Now, here's what they've done well. They delivered a stellar $6.8 billion in Q3 revenue, which was up 18% year over year, thanks to that surging data center and client processor sales. And speaking of data centers, revenue jumped 122% to $3.5 billion, fueled by their EPYC CPUs and Instinct GPUs. And of course, you can't mention AMD, you can't mention tech now without mentioning AI. And their AI push is awesome. They've partnered with Dell, Google Cloud, and Microsoft led to cutting-edge AI solutions unveiled at their Advancing AI 2024 event. And they also made a big acquisition of ZT Systems for $4.9 billion, which was bolstering their AI data center capabilities. Their CEO, Lisa Su, has absolutely transformed AMD into a titan, driving the stock from $3 to $140 during her tenure. And she's kind of like I think she's related to Jensen Huang. They're actually first cousins, which is pretty impressive. You have 2 cousins that are dominating the world of AI and chips. Now, there are challenges. Remember, every company has issues. I don't care what company it is. The thing is that when a stock is flying high, we tend to overlook those issues. And the stock is falling, we tend to overlook the good things that are happening. Why? Because news follows the stock price. And as principle-driven investors, it's important on this channel that we remember that. Now, the thing for AMD is they have very stiff competition. And this is where her cousin at NVIDIA dominates. Plus, gaming and embedded segments did see revenue declines, slightly dimming AMD's glow. Now, AMD reports on Tuesday after the close, so make sure you watch our 24/7 channel for our reaction and analysis after the report comes out. They're expected to report $7.54 billion in revenue and $1.09 in EPS. Let's see how that compares to what they did the same quarter last year. So that'd be for the final year. So they did $6.17 billion in that same quarter previously. That'd be a big jump. And the earnings per share would be per share quarterly, going back 41, that'd be $1.09 versus 41 cents. I mean, guys, an absolute home run for them. Now remember, we have a story. We have the numbers. We got to marry them together. You can't just focus on one or the other. You got to put it together to get those real multi-baggers. And that's why we have the stock analyzer tool. It allows us to take the story and make our assumptions about the future and put it all together, and it'll tell us what's the reasonable price to pay. Now, obviously, this is not where you stop or where you end all the time. You have to sit there and still make sure the numbers going in are valuable. So if you have our stock analyzer tool, which got used by over 1 million times last year, we've analyzed in our community over 8,500 individual companies since this came out and over 4,600 in last year. That's how important this tool is for making better decisions. So let's go pull up the last time I did AMD in this software. It was back on December 17th. Now, guys, I did a 10-year analysis. I did 8, 12, and 16% revenue growth. Profit margin, I did 8, 15, and 22. Same with free cash flow. Now, I want you guys to see this. In the last 10 years, they have not hit 15 or 22% margin. So I'm giving them major benefit here on the high side and the middle side even. That's kind of aggressive. And I'm just going to show that to say, hey, they're selling for 120 times free cash flow. Let's give them double the free cash flow. What would it look like? PE, I did 18, 21, and 24. Even though their ROIC is pretty low, this is a company that deserves a premium to the market, but they got to get this ROIC up. And my guess is as they're growing, as they're expanding, that's why this has been kept lower. So I'm still giving them a good benefit here, and I'm doing my 9% return. Clearly, that's a low return. 9 or 10% is the market number. I do this to get my intrinsic value. You got to put margin of safety in there because we're humans and we make mistakes and the future is unknown. So put a higher number in here, but this is to give me kind of like an intrinsic value for the business. I hit the analyze button. Again, the stock's at 117. I have a low price of 30, high price of 190, middle price of 85. So if I paid today's price and my aggressive middle assumptions occurred, I'm only making a 5% return. That tells me I need to be really patient on AMD. That's my opinion. So unless you have much better assumptions for AMD, it's going to be hard to justify it at today's price. And also, guys, this doesn't include dilution. If they keep issuing more and more shares, it's only going to make the stock price lower. Remember, garbage in, garbage out. If I went and assumed 100% revenue growth for the next 10 years, this company looks like a steal. But clearly that's not going to happen. So that's why you got to be cautious when using your stock analyzer tool. And if you already have it in our community, go in there and have conversations and get advice from people because it's the most common thing I see shared in our community is a stock analyzer tool. Stock number 2, Palantir. Guys, this company is a very, very, very famous company in the YouTube communities overall. Look at this company. Back in early 2021, it hit $45 a share. I said I was interested at $5. It hit $5.83. I never bought it. And now it's at $78 per share. Over 15x growth. That's absolutely incredible. And this company has been killing it on pretty much every metric you can imagine. Guys, in the last 5 years, their average free cash flow was $380 million. But last year alone, they did $980 million, almost $1 billion. Guys, do me a favor. Ignore all 5-year numbers in this company. This company is growing way too fast to even care about the last 5 years. But keep in mind, you got to focus on free cash flow here. Much higher than net income, $980 million versus $476. But guys, here's the scary part. It's worth as much as AMD. It only generated $2.65 billion in the last year. But look at this gross margin, 81%. 81%. 200 times free cash flow, 400 times net income. That's a lot, guys. And for a company this big, with a great balance sheet, look at this balance sheet. The market cap and the enterprise value are exactly the same. And there's one, my version actually has it lower. That means they have net cash on hand. They have more cash on hand. If they paid off all their debt with their cash, they'd still be left over with $4 billion. That's incredible. So let's look at the 8 pillars here. Just like AMD, all the same check marks. Amazing revenue growth, net income growth, free cash flow growth, very low debt. But look at these numbers. Now again, ignore the 5 years because it doesn't matter when you're growing. When you're growing this kind of pace, you got to ignore 5 year. But there are issues with Palantir. The good stuff with Palantir is they boasted 30% revenue growth in Q3 and a 44% US surge across commercial and government sectors. Now the question becomes, with Trump in office now, trying to cut all these costs government-wise, is that going to continue? But this is why I like the fact that a few years ago, they pivoted away from focusing just on government and said, we need to get commercial business, and they absolutely did that. And that's not easy to do. Their artificial intelligence platform is the real deal, fueling new contracts and expanding their customer base. Toss in a 340% stock rally in 2024, S&P 500 inclusion, and a BP partnership for AI-driven energy decisions, Palantir looks like a star performer, but you got to pump the brakes. It's selling at 175 times forward earnings. Valuation concerns have to be an issue. I don't care if you're the biggest Palantir bull in the world. You got to have concerns about that. When you're a $200 billion market cap, how do you sell for 175 times forward earnings, even with amazing earnings growth, and expect to make outsized returns? In addition, CEO Alex Karp, who I think is an absolute weirdo, cashed out $2 billion, and other executives have unloaded $600 million more. Now, you might sit there and say, Paul, it's only 1% of the market cap. True, but what percent of Alex Karp's net worth is that $2 billion? Listen, I don't blame him for cashing out, but it should be an indicator for other people saying, hey, if the CEO is selling majority of his net worth in the stock, isn't that an indication of where they think it is? But guess what? Their tailwind is a blend of potential and risk. As investors, we must focus on fundamentals in addition to the story. Great stories are fun, but profits are made when the numbers add up to the story. This could be a situation in which the numbers are a little bit more aggressive than they should be for the story involved. Palantir reports today after the close. We're going to have a reaction on our 24/7 channel around 5 p.m. Eastern time, so make sure you watch for that. They're expecting $780 million in revenue and 11 cents in EPS. You want to hear a joke? I bet they beat by a penny. The reason I say that is if you look at our past videos, our biggest concern was the adding of assets here and there to just beat by 1 penny on earnings per share. It's amazing to me because I look at their free cash flow and they're crushing on free cash flow. But I look at this thinking, okay, they beat by a penny, the stock has surged, and now the CEO and other executives have cashed out $2.5 billion. Doesn't that make you just at least question a little bit where people's incentives are? So let's go look at our stock analyzer again to see what makes sense for this company. So I'm going to let's put this up here, pull up Palantir, 3 assumptions. Okay, another 10-year analysis. 12, 18, and 24% revenue growth. Guys, this is a lot. Because even if you look at analyst estimates, let's go look at analysts. This is 5 years, and they're already dipping below 18%. Starting to dip below 18%. So it's something to consider here on the stock analyzer. Profit margin. I'm keeping profit margin and free cash flow margin the same. I just assume they'll converge at some point. 25, 32.5, and 40%. PE. I put 18, 22, and 26 and my 9% return. Now, guys, remember what I said. This is the tool you need to use in order to make better decisions about investing. But it's really important you use the tool well, like the thousands of people in our community who used it 1 million times last year. So if you've gone to our software from past videos to check it out, I'm sure you saw that we have a waiting list. And the reason we've done that is because we're making a lot of changes to the software. As of right now, it includes everything you see up here except for trading, but we're going to start splitting these things off very soon. We're making those changes behind the scene. I built this software originally years ago for myself. But as we were making videos, the most common question we got was, hey, how do I get that software? How do I get that Excel sheet? So we decided to make it, and it's done awesome. And guys, I use this software. My team uses this software every single day and every single week to make all of our investment decisions. But as we've grown, It is becoming less about me and more about how I can better serve you. And this is exactly why we update the software every single day. We have full-time developers working on this all the time. Now, these changes I talk about, they're already launching. So if you join today, we're still going to allow you to be grandfathered in for life with everything. That's the best deal we've ever offered. So as long as you join this, sign up at the link below or go to everythingmoney.com, $7 for 7 days to try it out. You'll get everything here, and I guarantee you it'll be the best investing decision you make this year. So back to our stock analyzer. I hit the analyze button on what I consider to be pretty aggressive assumptions, but not unreasonable. Like, to me, them doing 18% a year for the next 10 years in revenue growth seems reasonable. Here's the problem. $9 on the low side, 48 on the high side, 21 in the middle, and this assumes no margin of safety. That's what I have in my watch list at 15. But even if it hits 15, I still have to figure out, do I truly believe their numbers? It's hard to fake cash flow, but that EPS is just driving me nuts. They beat by a penny almost every single time. Stock number 3, Amazon. Guys, this is the everything company. 2.6 trillion market cap. Jeff Bezos hit $250 billion net worth recently. Great balance sheet, great cash flow. Again, look at this company. $11 billion, 5-year average free cash flow. They did $43 billion last year, but they're still selling for 60 times free cash flow. Now, this is a big growth company, but their gross margin is only 18%. But look at this profit margin. It's increasing. 5% in the last 5 years, but last year was 8%. My guess is it'll probably get better. Now, I think the gross margin on this company is a little bit weird. Like, I don't really think it's 18%. I think it's much higher than that, but it's kind of hard to get that feel for it. AWS is their biggest moneymaker, but I think that over time, they're going to make more and more money off of Amazon Prime and shipping and the product sales. You'd be surprised how little money they make off that. So let's go look at their 8 pillars here to see what's going on from this standpoint. Okay, we actually have 5 X's here and 3 checks, and the only checks are their revenue growth, net income growth, and free cash flow growth. But it's a lot, which is great. One thing I don't like is their 5-year free cash flow only increased by $23 billion, while their net income increased by $38 billion. And guys, just like the other companies, their 5-year numbers, I mean, they're growing their free cash flow a ton here. My guess is this reinvestment they've always made that I did not understand how it was going to lead to the bottom line. That's how it led to these big numbers. So you got to sit there and give them a little bit of credit for that. But the numbers don't lie. Their net sales, guys, for Q3 hit $159 billion. That's an 11% jump from the previous year. 11% doesn't sound like a lot. Guys, 11% jump on $160 billion. Even more exciting, net income soared 55% to $15.3 billion. That's not just growth. That's profitable growth. And by the way, AWS raked in $27.5 billion last quarter, riding the wave of AI and cloud demand. And guys, AWS is a very, very high margin business. And of course, Amazon's e-commerce dominance remains unmatched with over 40% US market share, poised to grow even further. Add in a 46% stock surge and a bold $75 billion AI-focused investment, and you have a company that is not only firing on all cylinders, but that firing could keep on going. But the issue is their current PE is over 47. It's now 51. Plus, they have big projects like Project Cooper, which could strain profits. They've got to invest wisely. Amazon will report their Q4 2024 earnings on Thursday, and they're expected to report revenue of $187 billion and earnings per share of $1.46. So make sure you watch our 24/7 for that one as well. Obviously, if you like earnings releases and up-to-date market news, you got to follow that. So let's go check out Stock Analyzer tool. This is going to be a hard one because you really don't know how they're going to grow their free cash flow and profit. So even if they have this growth of 4, 7, and 10%, you'll see this is why I put profit margin and free cash flow much higher, 7, 12, and 17. But again, I'm giving them credit here for something they haven't done. I don't think ever. They've never had 12 or 17% profit margin or free cash flow margin. So I'm sitting there saying, listen, these investments are going to pay off at some point. And that's the kind of investor a lot of people want to be. And that's how you get the big multi-baggers. but this is still making pretty good assumptions on almost a $3 trillion company, a $2.56 trillion company. I can understand if it was 2.56 billion, maybe even 25 billion. But geez, $2.56 trillion, that's a lot. You add in a PE, 20, 23, and 26, which I think is fully understandable. Yes, their ROIC is low, but I think it has to do with their poor numbers based on reinvesting. You look at that going, okay, but this is Amazon. They do everything. They're selling cars now. That's what's incredible. So I put my 9% desired return, hit the analyze button. The stock's currently at 238. I have a low price of 80, high price of 370, middle price of 190. And again, guys, I want to repeat, that's assuming profit they've never hit before as a percentage of their revenue. So I'm a little apprehensive about this. Now, guys, the question is, do the numbers even matter for these companies? Because a lot of people say they don't. And these companies are big growers. And that may be the case. But from a principle-driven investing standpoint, every investment is the present value of all future cash flows. You have to sit there and figure out if it makes sense to you or not. Guys, if you want to watch the top 33 stocks I'm buying in 2025, watch this next video. Thank you for your time.